Hey, everybody, we are going to talk about some stocks that you might not have heard of yet, but that are really good businesses that you should put on your radar. Tyler is joining me today. Before we get started, please check out fool.com/Frankel. Get the top 10 stocks to buy right now from the Motley Fool. It's the best way to support this work we're doing on YouTube. Again, that is fool.com/Frankel. So, Tyler Crowe is joining me today. Tyler's known for his kind of outside the box ideas. Um, and Here's another one for you today that is actually a really interesting business that I think could hold up well kind of no matter what the economy does. Tyler, take it away.
Sure. So I'm going to start off with like you said, a little outside the box, but it's called FTI Consulting. Not too dissimilar from a lot of other consulting groups. You know, you hear of companies like McKinsey or Boston Consulting Groups or things like that. But basically, the people that businesses bring in when they need help doing something that they may not necessarily be good at doing. Maybe they need to restructure after a merger or something like that. But FTI Consulting specifically, their bread and butter is a lot to do with like when companies explore strategic alternatives, or maybe they need to do layoffs or something like, things like they call it in fancy consulting terms, things like change management or enterprise transformation. It's a lot of things where it's like, we need to go find out who we need to lay off at a business, which I know it sounds bad, but they are necessary instruments of business. And as weird as it sounds, not a lot of businesses have that muscle memory built into their companies. That's like, oh yeah, we know how to fire people, we know who to lay off, and things like that. It's something that you just kind of may not have built into your business over time, and so you bring in a consultant to handle some of these sort of functions that you just may not be involved with. Now, what again makes it interesting is because it's not necessarily like a business where like, oh, it's some sort of trend. Companies are always laying people off. There's always somebody going through Chapter 11 bankruptcy, no matter how good or bad the economy is at every given moment. Companies screw up, things go bad. A merger and acquisition goes sideways. There's always some sort of need for this business, and because of that, this is a business that you know you're never going to look at it and be like, wow, it's shooting the lights out in terms of growth or anything like that. But it's a high return business, and it's a management over the past 8, 9 years that has really transitioned from, mergers and acquisitions, which in consulting doesn't make a lot of sense because you're just buying people. Like you're not buying assets when you make a merger and acquisition. In consulting, you're buying people, and it's just easier to hire good people. Like you're getting people in the door. You make a merger, all the people that you got in the merger might just leave. So with that transition of like kind of hiring up and focusing on the business itself, it's done a lot better. Per share value has accelerated. Its returns on capital have improved. It's been a nice turnaround over the past 10 years or so under the current CEO. And, the numbers really bore out on that sort of timeline over the past 10 years. This is a company that it's returned 520%, 7% on a total return basis compared to the S&P 500's 220. It at 25 times earnings, it's not the most expensive stock in the world, but I wouldn't call it the cheapest either. But a quality company paying for a relatively reasonable price that has proven to be a market beater, that's something that looks pretty attractive to me.
Nice. It's a really interesting play, and I think it's one that could do well. And it's an evergreen stock. It does well in any type of economy. It can do even better if things go poorly. Um, so one of my favorite things to do is look for the best company in terrible industries. And one of those in my portfolio is Empire State Realty Trust, ticker symbol ESRT. We just got a recent look at their earnings, and it's kind of impressive to see what this office REIT is doing. Um, office real estate, if you're not familiar, is not doing well. Um, Companies don't need as much office space anymore. A lot of companies went remote permanently during the pandemic. A lot are just kind of a hybrid work environment and are reducing their footprint. And a lot of commercial office owners are voluntarily letting their properties fall into foreclosure. They're, these they overpaid. They're not worth as much anymore because they're not very occupied. That's especially true with like kind of regional office properties. But for the most part, Manhattan offices are holding up pretty well. And that's where Empire State's portfolio pretty much all is. They own the Empire State Building. They own a bunch of other office properties in Manhattan. They also have some retail components to their portfolio. Pretty much any Manhattan office building, the first floor or two are going to be retail space. They also have recently started diversifying into apartments. So now, if you look at some of these numbers, you would have no idea that the office, commercial office real estate industry is not doing well. Their same store net operating income grew 8% year over year. That's not that's after adjusting for one-time items. So that's not just like they sold a building and made a lot of profit or something like that, or anything to that effect, or got back rent paid or anything like that. The Manhattan office portfolio is now 92.7% leased. That is 60 basis points better than at the end of last year, and is 2 full percentage points more than a year ago. And it's not that they're making a lot of rent concessions, which in a lot of cases, when office real estate is doing well today, it's because they're essentially giving it away. A lot of office operators are giving rent concessions. First few months are free, things to that effect. That's not the case here. Empire State's leasing spreads were over 5% in the first quarter, meaning that when a lease expires, the amount they're getting for it, either with that tenant renewing or leasing it to a new tenant, is 5.4%. That's the ninth quarter in a row. So pretty much since the pandemic era shutdowns ended, it's the ninth consecutive quarter in a row where their leasing percentage grew, and it's the 11th consecutive quarter where their leasing spreads were positive. Um, and it's not just the office portfolio that's doing well. They own the observatory on top of the Empire State Building, which is it's an absolute cash machine to have that kind of iconic business that you don't have to pay rent on because you already own the property. It's a very high margin business, very efficient, and it generates about a quarter of their total revenue from about 2% of their square footage. Really impressive business that produced 13% year over year operating income growth. And the company has a lot of cash on its balance sheet. It's very financially flexible. It does not have any um, short term maturities that it can't handle with just the cash on hand. And it trades for 10 times full year earnings estimates. So, best in breed company in a terrible environment, I think could be a real bargain rate at these levels. I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investment, so I'm proud to partner with The Motley Fool to bring you 10 stock picks from their popular product, Stock Advisor. Stock Advisor has beaten the market by more than 4 times, so go to fool.com/Frankel to get your 10 stock picks now. The Motley Fool Stock Advisor returns are 650% as of April 16th, 2024, and are measured against the S&P 500 returns of 148% as of April 16th, 2024.